Laughter, it's great for the soul, and dare I say it, most probably great for your health too. If you want to take in a lesson really well, you need to find a nice quiet place, put on your headphones and enjoy the growth which is going to take place in your bookkeeping space. Thanks everyone, or thank you for purchasing my work. You are a valued customer, and I hope you enjoy this different learning experience. In this video, I'm going to be covering the Cashbook receipts. You might know it as the Cash Receipts Journal. I will go through this journal in detail. We will look at what documents are used to record transactions in the Cashbook receipts. And from the Cashbook receipts, we're going to post to the general ledger. And I'm going to sow some seeds. And you're going to grow in this space. And you're going to grow. And you're going to flower. By the end of this video, you will be experts in the Cashbook receipt space. You will know what transactions go into the Cashbook receipts, what documents are used to record transactions in the Cashbook receipts, and we're going to take the information from the Cashbook receipts and we're going to put that information in the accounts in the general ledger. I'm looking forward to spending the next hour or so with you explaining this work. This is a very important slide. What you have in front of you is the bookkeeping cycle. I've joked here. I've said the yearly accounting cycle, and I've got a picture of myself cycling there. But what happens on a daily basis, I'm going to go through this picture here quite often because it gives you the overall picture of what you're doing as a bookkeeper. Transactions take place. They take place daily. And there are some examples. A capital contribution, cash purchases, credit purchases. By the time we finished all the journals, I would have gone through all the transactions that can take place in a sole proprietor. All these transactions are recorded on source documents. For example, receipts, invoices, debit notes, credit notes, statements. So all the transactions of your business or any business is recorded on a source document. The source documents are then used to record all the information, all the transactions in journals. And this is done on a daily basis and posted to the general ledger on a monthly basis. We will work through over time if you keep following me. I will do the general ledger with the journals, but also a debtors ledger and a creditors ledger. Then later reconciliations and a trial balance. I'm not going to worry yet about the dark green, but this is what happens at year end. The dark green blocks tell you what happened. The focus at the moment, as I mentioned earlier, is the Cashbook receipts and the types of transactions that end up in the Cashbook receipts is a cash contribution, cash sales, if a debtor pays us, someone we sold to on credit. Also, we can pick up information from the bank statement. For example, if we earned interest on our current account, when we get the bank statement, we will see that. All these transactions are recorded on documents. There's an example of a receipt. It's a little bit small there, but I'm going to go through each document. We have an invoice, a cash invoice for the Cashbook receipts. We have the cash slip, cash register roll. We have something called a deposit slip that is completed when we deposit money at the bank. And then, as I mentioned, this is just an extract, a piece of a bank statement. We are doing the books for Caleboo Education, and we get a statement from the bank, and sometimes there are transactions that are on the bank statement that we haven't yet recorded, and we need to record it. For example, the interest that we received on a positive bank balance. Don't worry, I'm going to go through everything. This information is recorded from the documents, and we're doing the Cashbook receipts. So we're going to complete this whole Cashbook receipts. And then from the Cashbook receipts, this is really small, but we're going to do it. You'll see it clearly. I'll do each item I'm showing you here individually. From the Cashbook receipts, we take the information to the accounts in the general ledger. In front of you, you have all the transactions of Caleboo Education. We're doing the books for Caleboo Education in this mock exercise, but I have all the transactions for the month of February. Now remember, we're doing the Cashbook receipts. So you will see in green, I've highlighted which transactions go into the Cashbook receipts. Any transaction that results in our bank balance increasing will go into the Cashbook receipts. So if Richard, the owner, myself, makes a contribution of 20,000, obviously that money is going to go into the business bank account and the bank balance will increase. That's why I've got this little picture here of our bank, because this transaction here will affect Caleboo Education's bank balance. We will also look at this transaction here. It's a sale of educational videos to the school. 3 videos were sold at 1,000 each. We will have a look at trade discount that was granted. The document that was issued by Caleboo Education was a cash invoice. The invoice was given to the school, and Caleboo Education was in possession of the duplicate invoice. But if we make a cash sale, obviously the bank balance will increase. It goes into the Cashbook receipts. The Cashbook receipts journal, or the cash receipts journal, records any transaction that results in our business bank accounts balance increasing. All these red blocks here, all those transactions go into different journals. For example, the general journal, the Cashbook payments, the creditors journal. So similar type transactions specifically go into certain journals. We're doing the Cashbook receipts. Anything that results in an increase in our bank balance goes into the Cashbook receipts, the cash receipts journal. So far I've highlighted a capital contribution and a cash sale. On the 12th, there's also a cash sale according to the cash register roll, a duplicate slip. A debtor someone that we sold to on credit paid us and we received the amount, we're going to deal with settlement discount as well, prompt settlement discount. That will go into the Cashbook receipts. So here are 4 transactions. The ones with the green next to them, that's CBR, stands for Cashbook receipts. Those 4 transactions on this page need to be recorded in the Cashbook receipts. Once again, anything that results in the business bank account getting bigger, the balance getting bigger, will go into the Cashbook receipts. So therefore, typical transactions. 1, let me put the dates on the 1st, on the 9th, on the 12th, and on the 14th. There are 4 typical transactions of any business, any sole proprietor, which need to be recorded in the Cashbook receipts. And more transactions took place, and we're looking through all these transactions. This is how a typical question will be asked. They give you all the transactions of a business for the month. You need to go and identify with each transaction into what journal the transaction needs to be recorded. But I've gone and worked through this already. And remember, we're looking at the Cashbook receipts. So on the 18th, there was another cash sale. On the 21st, this is an interesting one. It says here, we were informed that the school, a private business, was going into liquidation. So the current assets are less than the current liabilities. More about that in the future. But the school is able to pay us 60 cents in the rand of what was owed to us. So we need to go and find out what the school actually owed us on the 21st, and then you have to do a calculation. We're going to receive 60% of what the school owed us up until the 21st, because they're going into liquidation. So we'll deal with that transaction. We're going to get paid 60%, because 60 cents in a rand is 100 cents. We're going to get 60 out of 100, which is 60% of what the school owed us. We'll do those calculations. On the 25th, now this is quite interesting, we make more sales to the school. But this doesn't really matter. Even though the school has gone into liquidation, we're making a cash sale to the school. So we will receive the money straight away. When a debtor, someone that owes us money, like the school year, goes into liquidation, we're not going to offer them credit again. But on the 25th, they needed some material, some educational material, so we made a cash sale. Goes into the Cashbook receipts. Then on the 25th, there were more cash sales to customers according to the cash register roll. So what I've been doing now in the last 2 slides is I've been identifying all those transactions that need to go into the Cashbook receipts, the journal that records an increase in our business bank account balance. All those transactions that are going to result in an increase in our bank balance. Remember, our bank is an asset. If you really want to understand accounting and you haven't seen my video on the accounting rules, you need to check it out. So bank, if it has a positive balance, our bank account. It is an asset. Any transaction that results in an increase in our bank account will go into what I've highlighted in green here, the Cashbook receipts. Now, a few more transactions. Now, in fact, on this last page, yes, there is a sale. Cash sale according to the cash register roll. That needs to go into the Cashbook receipts. The cash register roll is the document we're going to use. It's a cash slip. We get a bank statement, and the bank statement shows that we earned interest on our positive bank balance of 173. Are there any more transactions? No. And this is where we are with your knowledge that you're gaining. We're just starting to shoot here. Seeds were planted. They sprouted. I think that's the right word. And you're growing. By the end of this video, you are going to flower. I like green grass. You can see the background here. I have green grass. I've put this up here because I just want to run through the bank account. Now remember, we're doing the Cashbook receipts. And I have mentioned this in the previous slides, but I want to highlight this. Any transaction that results in our bank balance in our books in the general ledger of Caleboo Education, if a transaction results in an increase in our bank balance, remember, it gets recorded in our books on the debit side, which is the left-hand side. And the reason why it goes on the left-hand side, if we have a positive bank balance, we have an asset. And if the value of the asset increases, so if our bank balance increases, any transaction in the Cashbook receipts results in our bank balance increasing, we will debit bank, and we total it all up in the journal, and we post the one amount, the Cashbook receipts. The purpose of a journal is to take the load off the ledger. In this account here, we don't list 20 transactions. We take the total from the journal of the Cashbook receipts and we put it in. So that is what we're doing here. If we owed our bank money, we were in overdraft, we were allowed to spend more than what we had in our business bank account, there would be a final balance on the credit side, and bank in that case would be a liability. But in this exercise, our bank balance has a positive bank balance, so the balance will be on the debit side. That's a summary of all the rules. Go check out that video. This B9 here is the folio reference in our books, Caleboo Education, for the bank account. B stands for balance sheet. This is a balance sheet account. B9. It's the 9th account in our books, in our balance sheet section. So there's just a bit of information on our bank account, because the Cashbook receipts affects our bank account on the debit side. An increase in our bank account goes in the Cashbook receipts. Any transaction that results in an increase in our bank account goes on the debit side of bank. I'm now going to look at the documents that are used to record cash receipts. This here is a cash tax invoice. The business that issued this cash tax invoice is Caleboo Education. So there's Caleboo Education, the address of Caleboo Education. This sale was made to the school, and it was for 120 lessons on the accounting rules, and there's the price. But my point is, this document, a cash tax invoice, is used to record a transaction in the Cashbook receipts. Caleboo Education will issue the original document and use the duplicate invoice, the duplicate cash tax invoice, to record this sale in the Cashbook receipts. So a cash tax invoice duplicate is the first document that I'm showing you, which is used to record a transaction in the Cashbook receipts. All these explanations here you can work through, but I have actually done a video on documents. You can go check it out. But for the purpose of this video, this is a cash tax invoice to record a cash sale to the school. And Caleboo Education will be in possession of the duplicate in order to record this cash sale in the Cashbook receipts. This is the cash tax invoice from the previous page. I just thought I would show it to you without all those markings. Just something I want to point out here. The terms and conditions of a cash sale is cash on delivery, COD. The customer, the school, can't buy now and pay later. This is a cash transaction. So the terms of a cash transaction would be cash on delivery, pay straight away for the items. This is a cash slip. What I've done just to demonstrate what a cash slip looks like is I've taken the slip from a local shop, because Caleboo Education, my business, doesn't use a till with a cash register roll, but a lot of businesses do. So what I've done is I've just put my logo at the top here, and I'm just going to say, just to illustrate what a cash slip is, I've sold bananas and I sold a lunch bar to a customer, and this cash slip here is left in the till. It's also known as the cash register roll. Now this document here is also used to record a cash sale, but I'm not making use of a slip, a cash register roll, but I've just put it in here because a lot of businesses do. And there you can see I went and actually bought some healthy bananas, but I have a sweet tooth, so I bought a chocolate. But a cash slip is used to record a cash sale. And which book are we looking at? The Cashbook receipts, or the cash receipts journal. Same thing. You might know it either as the Cashbook receipts or the cash receipts journal. Another document used to record transactions in the Cashbook receipts is the bank statement, which is a summary of transactions, in this case of Caleboo Education, for the month of February. We get this document from our bank, and any transactions that are on the bank statement in the credit column that are not in our books needs to be recorded in the cash book receipts. In this little example here, Caleboo Education has not recorded the interest earned on a positive bank balance until they're in possession of the bank statement. Then they will record this information. But another document that is used to record information in the cash book receipts is the bank statement that we receive from the bank. I don't want to go into this in too much detail, but this document here is a document of the bank that we bank with. In the eyes of the bank, a positive bank balance held by Caleboo Education is a liability. So what they're saying here is, remember, this document comes from the bank. It's not written up by Caleboo Education. In the eyes of the bank, this balance here, 447,173, is owed to Caleboo Education, and that fits the definition of a liability. When the bank owes us more, it's an increase in liability to the bank, and the rule says an increase in liability, the account must be credited. But this statement here from the bank looks at the relationship between Caleboo Education and the bank from the bank's point of view. From the bank's point of view. I have made a video on the relationship with your business and the bank, because in each set of books, from an accounting point of view, the bank balance is categorized differently. A positive bank balance in our books is an asset. If we have a positive bank balance in the eyes of the bank that we bank with, we are a liability to the bank. Okay, but for the purpose of this video, don't stress too much all about that. The bank statement is used to record transactions in the cash book receipts. Those items in the credit column that appear on the bank statement that are not yet in our books need to be recorded in the cash book receipts. Sometimes it's difficult to see the whole picture. That's when we need to have a little bit of faith, and things become a lot clearer and you see the whole picture. What I've got here, or what you have in front of you, is a receipt. If someone pays us cash, another document to record that is a receipt. We at Caleboo Education will write out a receipt. For example, here, this one was a receipt for a capital contribution made by Richard. This receipt is signed, in this case here, by Mama, my wife. This is just made up, although I do have a wife, but the amount is made up. 250,000 was a capital contribution made by Richard to his business, Caleboo Education. Then the cashier, Mama, received that money and documented this and issued a receipt. All money received, including that 250,000 received, is then banked. Now, in order to bank the money, we need to go to the bank and fill out a deposit slip. Now, a deposit slip is supporting documentation to record information in the Cashbook receipts. What happens is money comes onto the premises, either coins, cash, checks, and this money needs to be put in a safe place. So in this case here, Mama Marushka Driscoll will fill in this document, take the checks and the cash, and deposit the money into our bank account at the bank. But this document here needs to be filled in. And there you can see Shah Mama has just dropped off this money at the bank and filled in this deposit slip, and it was signed off. So a deposit slip is used to bank the money that has come onto our premises, because we're not going to sit with the money in our offices. That money needs to be deposited and earn interest, and there you can total up the amount that gets deposited. So this is another document that is used for supporting documentation for the transactions that have taken place during the month that go into the Cashbook receipts. It's time to recap. These are the documents that Caleboo Education most of the time uses to record transactions in the Cashbook receipts. Some nice blue sky here. A receipt. A receipt is used to record monies received. The original receipt will be given to the person that paid us in cash. Caleboo Education keeps the duplicate receipt to record the transaction in the Cashbook receipts. Document number 1, a receipt. Number 2, in any particular order actually, but the second one on our slideshow is the cash tax invoice. Once again, we are the bookkeepers for Caleboo Education. We issue to the school the original document, and we keep the duplicate cash tax invoice to record the transaction in the Cashbook receipts. A cash slip, if you use that in your business, is used to record a cash sale in the Cashbook receipts. What happens once we've received all this money? We go to the bank and the money gets deposited in our bank account. A deposit slip is supporting documentation to the transactions that took place during the month where we received money. Then we get a bank statement from the bank that we bank with, and we use this document to record transactions as well in the Cashbook receipts. So now that we know which documents are used to record transactions in the Cashbook receipts, I can eventually introduce the Cashbook receipts. So we're going to look at the Cashbook receipts of Caleboo Education for the month of February. Before we start entering these transactions into the Cashbook receipts, I want to run through the column headings. So we have a column for document. So you're going to fill in the document number, the type of document and the number. For example, R1 is receipt number 1. INV 31 is invoice 31, obviously a cash invoice. The day the transaction took place, details, this first transaction, Richard made a capital contribution. So the details column in the Cashbook receipts tells you more about the transaction. There's a column here for folio. Sometimes we receive money, for example, from a debtor, accounts receivable, the school, and we will fill in, for example, the debtor's folio, and I'm just making this up. In fact, in our example, D1 is debtor number 1, the school, in the Debtors Ledger. So folio will give us a reference for the school. It's debtor number 1. Analysis of receipts, I'm going to come back to this column. I'm going to explain it because it often causes confusion. I'll explain it now and later. Let's say 20,000 was deposited by Richard, and then there were sales of 2850 on the 9th. The analysis of receipts column records money that comes onto the premises. It's a workings column. So this money was received. It was not yet banked until the 9th. So what happens is the analysis of receipts column serves as a workings column. You will see there will be supporting documentation, as I've mentioned before, duplicates of deposit slips. What money was deposited into our bank account. And I will show you in a moment that on the 9th, 22,850 was deposited into our bank account at the bank. That comprised of 20,000 plus 2,850. So the analysis of receipts column, it is not an account in the general ledger. It's a workings column to record what money was received onto our premises as opposed to directly into our bank account. This money here, 20,000 plus 2,850 was received onto our premises. The money was banked on the 9th. How did we know that? We're going to get duplicates of deposit slips. I will show you that in a moment. So the analysis of receipts column records money that is received onto the premises. There's some cash sales, there's some money from the school, there's some more sales. It was banked. These three amounts were added up and banked on the 18th. So the analysis of receipts column is a workings column. It also records money that was received onto the premises. Then we have bank. The bank column is the column in the Cashbook receipts. Any transaction that gets recorded in the Cashbook receipts, the one account that is affected by the transaction is always bank. Then there's VAT. If you're doing VAT, services rendered, if a debtor pays us, sales. Those are the types of transactions that take place at Caleboo Education. When does something warrant its own account? If a transaction happens on a regular basis, it will have its own column in the journal. If it only happens every now and then, it will appear under sundry. And under sundry, there will be a column for amount, folio, and details. Details column will record the contra account, the other account affected by the transaction. Remember, in this journal, the one account is always bank, because this journal here records all those transactions that affect which account? Our bank account positively. And the account that is credited will either be services rendered, debtors, sales, capital, output VAT. Then there's a column here for cost of sales. Now the cost of sales column is recording the fact when we make a sale, we are getting rid of trading inventory. At the point of sale of stock, trading inventory is expensed, and we show there was an expense to the sale, and it was the cost of the sale. More about this column in the future in this video. It's an interesting column, and I'd like to explain it in some detail. I like it, but you need to understand it properly, because two accounts are affected by these amounts in the cost of sales column. And then over here, above that line I've just drawn, it says CBR2. It's the second journal, Cashbook Receipts 2. You can have any folio for your journals, but it makes sense to me because it's Cashbook Receipts number 2, because it's February, the second month of the year. In the heading of the journal, you're going to say Cashbook Receipts of the name of the business for February, and then it gets a folio reference, Cashbook Receipts number 2. Now what I went and did here was I've highlighted this analysis of receipts column, which I explained earlier. Remember, the money that comes onto the premises gets deposited. This deposit slip is filled in, and the cash and checks and coins are given to the bank teller at the bank with the slip. And then these slips here show you, or show us, the bookkeeper, how much was deposited on a specific day. Normally in an exercise, they will give you this information. They will say duplicates of deposit slips for February. So on the 9th, 22,850 was deposited. On the 18th, 51,543. The teller, the bookkeeper, whoever is responsible for depositing this money, does not go to the bank normally on a daily basis. They wait till they've received a little bit of money, and then they go on the 9th, on the 18th, on the 25th, and the 28th. And where are the workings done in our books? In the analysis of receipts column. Let's see if I can just rub some stuff out here, and you will be able to see what I've been talking about. Okay, behind all these markings, I have taken a screenshot of the analysis of receipts column, and just quickly have a look here. I did explain this earlier. On the 1st, Richard made a 20,000 Rand capital contribution. Then there was sales. These two amounts were deposited on the 9th. They give you this information. Then 22,850, the two amounts added together, were deposited into the bank account. Then on the 18th, it was 51,543. I hope this analysis of receipts column is a little bit clearer. You do not total up the analysis of receipts column right at the bottom. You check at the duplicates of deposit slips, and on the 9th it will say 22,850. And then the next deposit, I can't see now, let me rub it out, was made on the 18th, and it was 51,543. There, it's behind this information, 51,543. So the analysis of receipts column is a workings column. It records all the information that comes onto the premises. Then you get the supporting documentation, the duplicates of deposit slips to tell you how much was deposited on what date, and that appears in the bank column, the deposits on the dates. I hope that is clear. Let's move on. I'm going to take Caleb's advice there, and I'm going to go through this slide slowly. We've reached the crux of the matter. Remember, this video is about completing the Cashbook receipts of Caleboo Education for the month of February. So I'm going to go through each transaction with you, and we're going to complete the Cashbook receipts. We've got here the duplicates of deposit slips for February. I just want to recap on this. What this is telling us is that on the 9th, 22,850 was deposited at the bank. There it is, 22,850. On the 18th, 51,543 was deposited, consisting of those amounts, the transactions that took place the 12th, the 14th, and the 18th, totaled 51,543. So in this bank column will be the amounts that appear on the deposit slips. I've discussed the deposit slips already, so I'm not going to go into too much detail here. So let's perfect the Cashbook receipts. I'm going to run through all the transactions which relate to the Cashbook receipts that we identified on the transactions for Caleboo Education at the beginning of the exercise. So the first transaction, Richard made a capital contribution of 20,000. Now, this money was given to the cashier in cash on the premises at the building. Okay, we know it doesn't normally happen like this, but quite often in the textbooks, these type of transactions are still happening. And the reason I know this transaction happened like that is because a receipt was issued. There was a receipt issued, which implies that the cash was given to the cashier on the office block, right at the place of work, the 20,000 Rand contribution was made. So the document is R1, receipt 1. The day is the 1st. Under details, it tells you more about the transaction. Richard, the owner, made a cash contribution of 20,000 under analysis of receipts. It does not appear under bank at the moment because in the previous slide I showed you the duplicates of the deposit slips. The money was not banked on the 1st. So under bank there is nothing. And there is no column for capital because a capital contribution doesn't happen on a regular basis. So the transaction will be recorded under sundry. The amount was 20,000 and the contra account to bank, the other general ledger account, is capital. When we do the general ledger, you will see the folio for capital is B1, but we'll come back and fill in the folios. So that is the transaction, the first transaction. Richard made a cash contribution of 20,000. Hopefully that's clear. When there's a cash contribution, there's no VAT involved. You can check out my video on VAT. It's quite informative. Right, let's move on to the next transaction. Sold more accounting videos. This is on the 9th to the school. This was a cash sale. 3 videos at 1,000 Rand each. That's 3,000 Rand. 3 times by 1,000 is 3,000. The school was given a trade discount, most probably to encourage sales. This customer we deal with on a regular basis, so we gave them a 5% trade discount. A cash invoice was written up and issued to the school. So let's record this transaction. Document, they tell us, was invoice number 31. The date was the 9th. Under details, we go and write sales again. I've never quite understood this because details should tell you more about the transaction, but we do have a column for sales. But most of the textbooks, when a sale is made, in the Cashbook receipts, under details, they write sales. So let's write sales. The amount, interesting, we do not record trade discount. And I've given you a line to show calculations. The amount 2850 is calculated by saying 3,000, because there were 3 videos at 1,000 Rand each, which makes 3,000, but a trade discount was given of 5%. Now what I've gone and done to do this quickly is I've said 3,000 times by 95%. I've taken off the 5%. You could have done the calculation differently. You could have said 3,000 multiplied by 5% of 3,000, but I did it the most efficient way. Often in an exam or a test, you're pushed for time, so you need to learn the tricks of the trade. 3,000 times by 95%, that's taking off the 5%, which was trade discount, gives me 2850. Now this amount under bank is the total amount that was deposited on the 9th. consisting of the capital contribution and the 2850, and the total is 22,850. Now when we make a sale, we collect output VAT on behalf of SARS. The output VAT is calculated. You can go check my VAT videos, very detailed information there, but I'm going to show you how to do the calculations here. So the amount after the trade discount is 2850. If I want to get the VAT amount, I multiply by the VAT fraction, 15 over 115, assuming that the VAT rate is 15%. So 2,850 multiplied by 15 over 115 gives me 371.74 cents. Then the sales amount excludes VAT, so we say 2,850 minus the output VAT of 371.74 is equal to 2478 and 26. Now what we need to do, and this is very interesting, and I'm going to put a star next to this, we need to calculate the cost of the sale. Now Caleboo Education uses a 40% markup on cost. I've done a video as well on markup on cost price and markup on selling price. We take the original selling price, excluding VAT, 3,000, we divide by, I beg your pardon, this 3,000 here included VAT. It was 1,000 videos, 3 videos at 1,000 Rand each. Right, VAT is always included in all these transactions unless otherwise stated. So 3,000, and I want to take off the VAT. I say divide by 1,15, then I divide by 1,4. The markup on the cost price is 40%. That's where that 40 comes from. And right in the beginning of the exercise, I will let you know if I didn't. The markup on the cost price is 40%. So to get the cost of the sale, we say the invoice amount, 3,000, before trade discount. Take off the VAT by dividing by 1,15. Then I take off the markup on the cost price by dividing by 1,4. And the answer to calculate the cost of the sale is 1,863 and 35 cents. Let me summarize that transaction again. What I'm going to do quickly is just rub out these markings, and I'm going to explain this one again. So we, Caleboo Education, sold accounting videos to the school. There were 3 videos of 1,000 Rand each, but there it is, 3 videos at 1,000 Rand each. Caleboo Education gave the school a trade discount of 5%. So 3 times 1,000 is 3,000. So the amount that the sale was actually less than 5% is 3,000 multiplied by 95%. I took off the 5% trade discount, which gives us 2,850. Once again, don't get confused. This 22,850 includes the capital contribution and the sale. That money was banked according to the duplicate deposit slips in the previous slide on the 9th, 22,850. So the output VAT that needs to be collected on behalf of SARS is the amount after trade discount 2850 multiplied by the VAT fraction 15/115 when the VAT is 15%. And if you punch that into your calculator, it equals 371 and 74 cents. We then get the sales amount excluding VAT, and we say 2850, that is the sales amount, less the VAT amount we just calculated, is equal to 2478 and 26. Now this business operates on a 40% markup on the cost price. Now the cost price needs to be calculated, cost of sales, cost price, needs to be calculated using the amount before trade discount. And the amount before trade discount is 3 times 1,000, which is 3,000. We need to take off the VAT, so we divide by 1,15 because VAT is 15%. 3,000 divided by 1 is 3,000, but we need to take off the VAT, so we say plus 15%. 3,000 divided by 1,15. You need to know how to convert a percentage to a decimal. Then to work out the cost of sales, after we've taken off the VAT by dividing by 1,15, we divide by 1,4, which is 1 plus 40%, because the markup on the cost price is 40%. And that gives us the cost of sale, 1863 and 35 cents. It is important to note here that the cost of sales is calculated on the selling amount before the trade discount, because whether a trade discount is given or not, the cost of the items we are selling is still the same. So it needs to be calculated on the amount before the trade discount. And I've taken off the VAT and I've taken off the markup to get 1863 and 35. That transaction there needs special attention. It's not that easy. So you need to work through that again. Rewind the video and watch it again. Let's move on to the next transaction. And the next transaction took place on the 12th. And it's quite a standard transaction. Cash sales according to the cash register roll. Remember, all amounts include VAT unless otherwise stated. So the document here is the cash register roll, the duplicate cash register roll. The date is the 12th, and remember, under details we'll stick to the text and just write sales. You might maybe want to record, even though it's a cash sale, under details who we sold to, but sales is good enough. According to the cash register roll, means that the money came onto the premises And remember, the cash register roll is inside the till. So we rang it up and we gave the customer a cash slip, and we were left with a duplicate, the cash register roll. The amount, including VAT, of the sale was 12,900. The money was not banked on the 12th, so there's no amount under bank. And the output VAT is calculated by saying 12,900 multiplied by the VAT fraction, and that gives us 1682 and 61 cents. If you hear that plane flying over, I apologize. If I want the sales amount, which is 11,217 and 39, remember the sales amount excludes VAT. 12,900 minus the output VAT is 1682.61. That's the amount of the output VAT. So the selling price excluding VAT is 11,217 and 39 after taking off the VAT. And then the cost of sales is the sales amount divided by 1,4. Remember, the markup is on the cost price and it's 40%, so I can divide by 1,4. 40% as a decimal is 0.4. You divide by 1 plus the 40%. And there's the cost of sales. That is actually the amount of the stock we got rid of from the sale at its historical cost price. Remember, at the point of sale, the trading inventory is expensed, and we open up an account called cost of sales. We will see when we finish this journal, the total of the cost of sales column will be taken or posted to 2 general ledger accounts. So that's what happened on the 12th. There was a cash sale according to the cash register roll. Let's move on. Now we're going to have a transaction that relates to one of our customers, the school. We sell to the school for cash, and the school has an account with us. We sell to the school on credit. But seeing that we're in the Cashbook receipts, we are dealing with cash transactions. So let's see what this transaction is, which relates to the school. On the 14th, the school paid us, and we gave them a 3% settlement discount for paying us quickly, a prompt settlement. Now this is quite interesting because the school paid us on the 14th, but how do we know how much the school owes us? Now you would have to, if you get asked a question like this, you need to go and write down all the transactions in your workings on a rough piece of paper that relate to the school. And then you can determine how much is owed by the school on the 14th. Now what happens in reality, you might also be given the Debtors Ledger with the account of the school, and it would look like this. This is very small, but all we need is what was owed to us on the 14th. This is the account of the school, accounts receivable. The school owes us on the 14th 26,694. But remember, they are going to get a 3% prompt settlement discount. Now, what I'm doing here, because some textbooks will record this in different places, I'm going to record the amount that we received, and what I'm going to do in the general journal, when we get to the general journal, is record the discount that was allowed, the settlement discount. Some textbooks might have in the Cashbook receipts or the cash receipts journal a column for discount allowed. What I'm going to do in this mock example, the discount is going to be recorded. We are going to record it in the general journal. But what we need to record here is the amount of money that we are receiving from the school on the 14th. We are going to receive what was owed on the 14th. There it is, 26,694. Calculators are useful tools. You can say 26,694 minus 3%, or you could have multiplied by 97%. It's up to you to play around with the methods that you use, that you're comfortable with, but you need to get to 25,893. So we received from the school the amount that was owing on the 14th less a 3% discount, and that answer is 25,893. And underneath debtors control, this column is the debtors control column. Unfortunately, it's blocked by the debtors ledger. The amount that was settled by the debtor is 25,893. So there we go. And also that money, nothing appears under bank at this stage, because on the 14th, the money received was not deposited. We will see all the money received on the 12th, the 14th, and the 18th was only deposited on the 18th. So there we go. The school paid us the amount owing on the 14th. On the 18th, there was another cash sale. The amount, including VAT, was 12,750. So it gets recorded like this. The document is the cash register roll, the duplicate. The date is the 18th. Under details, we'll just put sales. This money came onto the premises. It's 12,750. Now, this is not 12,750 because according to our duplicate deposit slips, the money from the 12th, the 14th, and the 18th was deposited only on the 18th, 51,543. That is the total amount. If you include the 12th, the 14th, and the 18th, the money was deposited on the 18th. But the sale on the 18th was 12,750. Now, if we want to calculate the output VAT from this sale, we multiply 12,750 once again by the VAT fraction. You can multiply by the VAT fraction if this amount includes VAT. There's a different way to do this. You might have actually thought about it already. You can say 12,750 divide by 1,15 to take off the VAT will give you 11,086. But what I'm doing is I'm multiplying the sales amount including VAT by the VAT fraction in order to get the output VAT. What I just said, I'm taking the sales amount including VAT multiplied by the VAT fraction, and that gives me the output VAT on this sale of 12,750. And the output VAT is 1,663 and 4 cents. And if I say 12,750 minus the output VAT, I'm going to get the sales amount excluding VAT. And if I take the sales amount excluding VAT and I divide by 1 plus the 40% markup on cost, 1,4, there it is, 11,086.96 divided by 1,4 will give me the cost of sales amount. The cost of sales amount is 7,919 and 26 cents. So there's another transaction. It was recording cash sales according to the cash register roll, 12,750. I've been so focused, I've been avoiding VAT Boy, and he's been popping in on the previous slides. So I apologize, VAT Boy. He's come to check up on the output VAT, and he's been trying to make an appearance. So hello, VAT Boy. Welcome to this lesson. So let's have a look what happens here at Caleboo Education on the 21st. This is what the transaction read. We were informed that the school with whom we do business was going into liquidation. We are going to receive 60 cents in the rand of what was owed to us, and the balance is to be written off. Caleboo Education issued a receipt as proof of payment, so we acknowledged that the school paid us a sum of money. But the question is, on the 21st, what did the school owe us? Now we need to investigate. Let's see, this is our customer, the school. If we on a daily basis had been doing the debtors ledger, all these transactions relating to the school, like I said, would have been posted on a daily basis to the debtors ledger. Don't worry if you can't see this too well. All we're concerned with finding out is what the school owed us on the 21st. Now this is the account of the school in the debtors ledger, and what that does is it keeps a running balance of what is owed to us. And if we go down to the 21st, the amount that was owed to us, if you can't see it, it is 12,785. Now, according to the transaction, we are going to receive 60 cents in the rand, which is 60%. We're going to receive 60% of the amount that was owed to us. And it's calculated as follows. If we look there, we issued a receipt and we kept the duplicate to write up this transaction. The day was the 21st. Who paid us? The school. And just while we're here, the school had a failure reference because we have the debtors ledger where I circled there. it says D1, debtor number 1. The school was our first debtor, the first account that we issued was to the school, and we gave them the reference D1. So we fill that in, D1. On the 21st, they owed us 12,785, and we're going to receive 60 cents in the rand, 60 out of 100, 60 cents out of 100 cents. So if we multiply 12,785 multiplied by 60 over 100, we get 7671. So what did we receive from the school? 7,671. Now the remainder, 40 cents in the rand, is going to be written off, and the write-off amount is going to be done. We will do it in the general journal. So if you watch my video on the general journal in this series, you will see we will write off the 40 cents in the rand that we're not going to receive from the school. So there we go. On the 21st, we've recorded the 60 cents in the rand that we're going to, or we have received, of the amount owing, and the amount owing we picked up from the Debtors Ledger. If you're not given the Debtors Ledger and you're only given the transactions, you're going to have to do this here in rough workings. You can keep a record of all the transactions right through the month up until the date of the transaction we're looking at, in order to determine how much the debtor owes us. So there we go. That's what happened on the 21st. Let's look at the next transaction. On the 25th, there was another cash sale according to the cash register roll. Now we've done a few of these. So there's the document, the cash register roll. Day is the 25th. Under details, we're just going to put sales. The amount was 9,800 under analysis of receipts. I've discussed the bank amount, which here consists of a few amounts to get to the 17,471. Remember, you check the duplicates of your deposit slips, and the amount that was banked on the 25th was 17,471. Now output VAT needs to be calculated. So we say 9,800, which is the inclusive amount of the sales, the VAT inclusive amount. 9,800 multiplied by 15 over 115 is 1,278 and 26 cents. Then 9,800 minus the output VAT. Let me say that again. Just rub this out. The 9,800 minus the output VAT we just calculated gives us the sales exclusive amount, sales excluding VAT, of 8521.74. And to get to the cost of sales, what do? We divide by, that's a divide by sign, 1,4. Because remember, the markup on the cost price is 40%. So we divide by 1,4. And that gives us the cost of sales amount. Now, sometimes in a test, they might only give you the cost of sales amount. So I now have to work from the cost of sales amount to the eventual selling price, including VAT. And it's quite easy. If you can work it from left to right, you can go from right to left. So if we had to work from the cost of sales amount to the sales amount including VAT, we would say cost of sales multiplied by 1,4 multiplied by 1,15 is going to give me 9,800. So what you need to do when you prepare for a test or exam is you need to be able to work out these amounts even if you're only given the cost of sales amount, and you need to work to the sales amount including VAT. So there you go. You need to know how to do these calculations. Right, we're back with the school, and we move to the next transaction, and guess what? We're doing business with the school again. We make a cash sale to the school. Remember, the school only a couple of days ago on the 21st went into liquidation. Now, if we're making a cash sale to the school, maybe a parent donated some money to buy some material, I don't know, but they've come into some cash and they're looking for some items. So we do business with them, but it's a cash sale. You're not going to put something onto their account again. Their account is closed because they were a bad debt. We don't do any credit transactions with them again. This cash sale does not get recorded in the school's account in the Debtors Ledger. Here it is. On the 25th, according to the cash register roll, we sold 2,500 worth of stock. To get the output VAT, we say 2,500 times by 15 over 115 is 326. That will give us the sales amount excluding VAT. The sales amount excluding VAT. And if I want to get to the cost of sales, I say 2173.91 divide by 1,4. In this little calculation here, I actually went and calculated the sales exclusive amount by saying the sales amount of 2,500, there it is, divide by 1,15. That's how you take off the VAT. Another way to take off the VAT. And the amount is equal to, I'll rub out what's blocking the amount, 2173. And let's see how many cents there was. 91 cents. So there are different ways to derive these numbers. If I were you, I'd try and master all the different ways. And the more you practice, the better and quicker and more accurately you're going to do things. And that's what you want when your time is limited in a test. Okay, not many more transactions to go. Let's check what's on the next slide. Like I said, not many transactions left. Let's see what we got. On the 28th, there were cash sales according to the cash register roll. I'm going to move through this quite quickly. Under details, we have sales. Under analysis of receipts, this money came into the shop, onto the premises, 7,300. On the 28th, two amounts were deposited into bank according to the duplicate deposit slips, 9,800. The output VAT on this particular sale on the 28th is 7,300 multiplied by 15 over 115, which is 952.17 cents. The sales amount, excluding VAT, is 7,300 minus 952 and 17 cents. Then to get to the cost of sales, we take the sales amount, excluding VAT, divide by 1,4, and that gives us the cost of sales. You guys are becoming experts at this, masters. And the last transaction in the Cashbook receipts, we had a favorable bank balance and we earned 173 interest on the current account. Remember, there is no VAT on interest. Where did we earn the interest? At the bank that we bank with. How did we find out we earned interest? We received a bank statement, and on the bank statement from the bank with whom we bank is interest, and in the credit column it's 173, and our bank balance increased by 173. We need to record that transaction in our books. It does not appear under analysis of receipts because the money was credited directly to our bank account, and the bank now owes us more. Bank 173. There is no column for interest on current account because it most probably only happens once a month. So under sundry we have 173, and under details we have the name of the contra account to bank, which is interest on current account. And later on we will come back and fill in a folio when we know what the folio is for interest on current account. Hang in there, we're nearly there. If you want to put your 3-year-old to bed, play this accounting lesson. They will fall asleep quite quickly. But you hang in there, we're getting there. Well done for getting this far. It's fantastic working with you. Your knowledge is increasing, and soon you're going to flower with regard to the Cashbook receipts. Keep up the good work. This is what the completed Cashbook receipts of Caleboo Education for February should look like. Here we have all the transactions. I've taken out the workings. So if you were doing your books manually, this is what the Cashbook receipts would look like. There's your details column. You got all your documents, the day the transactions took place. By the way, there are 29 days in February 2024. It's a leap year. The amounts that came through the shop on the premises are recorded in the analysis of receipts column. And then according to the duplicate deposit slips, money was banked on the following days. The 173 did not get recorded in the analysis of receipts column because the money, the interest earned, went directly into our bank account. Output VAT was calculated. There were no services rendered, which is current income, for the month of February. Say, for example, an extra lesson. There were no services rendered. We received money from our only debtor, the school. There are the amounts received. Sales took place to the value of 41,826 and 9 cents. Remember, this amount excludes VAT. And there were a couple of sundry transactions. The capital contribution and the interest on the current account, the interest earned. Cost of sales was calculated after each sale. When we post to the general ledger, we're going to take this information to the general ledger. That's the next step on the accounting cycle, the bookkeeping cycle. I will show you where these amounts go in the general ledger, and I will show you why an account is debited and why an account is credited. We will apply some of the rules. So that is a cash book receipts. The next step is to take this information to the general ledger. The purpose of this journal was to take the load off the ledger. You will see we're not going to post all these transactions individually to the general ledger sales account. We take the totals to take the load off the ledger. So we've totaled up all these columns. You will see what we do with sundry, because sundry, these accounts do not have their own column. It's quite exciting. You have gone from a flower bed and your brain has grown and it is almost ready to flower in the next few slides. That is going to happen. So let's see what's going to happen. Now that we've finished the cash book receipts, the next step in the bookkeeping cycle is to take this information to the accounts in the general ledger. What this is called is we're posting the information from the journal to the general ledger. When you're doing this, you develop your own methods, but it's quite important in the general ledger to try and keep all the transactions in date order. Now, what I'm going to do here is, if a transaction appears under sundry, the transaction is posted to the general ledger on the day the transaction took place. If an account has its own column, like Debtors Control, the total is posted to the ledger account at the end of the month. So let me just repeat that. If a transaction appears under sundry, the transaction is taken to the general ledger account on the day the transaction took place. If an account like Output VAT has its own column, the total at the end of the month is taken to the general ledger account, in this case Output VAT. So what I'm going to do is I'm going to post all this information to the general ledger. I'm going to show you each posting individually, and after a short while you will get the hang of it. So what I'm going to do is, obviously I start here at the first. Under sundry there's 20,000 and it was a capital contribution. Now let's take that information to the general ledger. Now capital is an account in the general ledger. It's the owner's account, and I've just popped up the rule for capital. If there is an increase in the value of capital, the owner in this case here actually put in 20,000. There was an increase in capital, the account needs to be credited. So if I just clear that, what we're going to do to the capital account is we're going to credit B1, which is the capital account. and I've taken the capital account from the general ledger. I will show you a completed general ledger once I've gone through all the postings. Now, according to the rule, an increase in capital must be credited. And if you remember from previous videos, the left-hand side of the general ledger is the debit side, and the right-hand side of the general ledger is the credit side. And capital, you will see when I show you a trial balance for Caleboo Education, it's balance sheet account number 1. That's why it says there B1. So the rule says an increase in capital, it must be credited. You write 2024 February. When did this transaction take place? On the 1st. Remember, if it appears under sundry, which capital does, we post this information on the day the transaction took place, which is the 1st. Under details, the contra account to capital, remember the one account in the Cashbook receipts will always be bank, and under details you write the name of the other account affected by the transaction. So under details here you got bank, and where did the information come from? The Cashbook receipts. Okay, I've gone and written here the cash receipts journal. It's the same thing as the Cashbook receipts, and it's the second Cashbook receipts or cash receipts journal for the month or for the year of 2024, and it's for February, so it's CRJ2. So if I was looking at the general ledger and I wanted to find the details of this transaction, that folio reference points me to the journal, the cash receipts journal number 2, the Cashbook receipts journal number 2, and the amount is 20,000. Let me clean this up quickly before we move on. So in the bookkeeping cycle, I've completed the journal for February, and now what we're doing is the next step in the cycle. We're taking the information from the journal to the general ledger. So capital needed to be credited with 20,000. According to the rules, an increase in capital, the account must get credited. Under details is the name of the other account affected by the transaction, and if it's in a cash book, the one account will always be bank, and there's the day the transaction took place. You have now posted your first transaction from a journal to a general ledger account. So there we're popping up, you are growing and you're going along the path. Don't get sidetracked, stay focused, and you'll get to flower quicker. So there we go. There's the first transaction being posted to the general ledger. I will show you the complete general ledger when we've posted all the information to the general ledger accounts. We've now taken the information with regard to capital to the general ledger. We've posted that information. Now what I do is I'm going to work from left to right through the columns. Just by the way, that little green, I don't know what you call it, green picture here. On the 9th, remember it's the duplicate of deposit slips on the 9th, the 18th, the 25th, and the 28th. They're just saying that amount of money was deposited at the bank. So during the month of February, 4 deposit dates took place, and that's the amount of money that was deposited in the bank account. Now we need to take the information with regard to the columns to the general ledger. Remember, analysis of receipts is a working column. It's not a general ledger account. So now we're posting to the bank account. The bank, we have learned, if there's a positive bank balance, it's an asset. Now, when we receive money from a capital contribution, sales, from a debtor, from interest on a current account, our bank balance is increasing. And the rule says an increase in assets, the account must be debited. So we're going to debit B9, which is the bank account, in the general ledger. We take the total for the month of February and we post that to the bank account in the general ledger. And for February, the 101,837 is the total receipts for the month. That must be taken to the bank account in the general ledger. So here's an extract from the general ledger of Caleboo Education. We have the bank account, and according to our rules, an increase in assets, we need to debit the bank account. We put in the date, 2024, you can abbreviate February, FEB. 2024 is a leap year. You take the information from the bank column on the last day of the month, and we have total receipts. Under details, we can't write the name of every contra account. For example, sales, debtors, interest on current account. This is like a collective noun for all the money received in the month of February. Total receipts. The information came from the Cashbook receipts number 2, and the amount was, for the month of February, 101,837. That is the cash we've received for the month of February. Now in the bank account, this is only the posting from the Cashbook receipts. There can be obviously an opening balance and a closing balance and total payments. But in the bank account, we only write here total receipts. We do not post these transactions individually. We had a column for bank, so on the last day of the month, we take the total to the bank account and its total receipts on the last day of the month. Remember, what is the purpose of a journal? It's to take the load off the ledger. And what that means we don't have 10 transactions inside bank. We have one at the end of the month, and it's a total of all the money we've received for the month of February. So that total there gets posted to the general ledger. It was debited because bank is an asset. We have a positive bank balance. Because of all the money we received, that asset bank, the value of our bank balance increased. We debit the bank account. There we go. We debit the bank account in the general ledger. So that there is the posting of our total receipts for February to the bank account in the general ledger. Now, as you do this more often, you will develop your own methods to post to the general ledger. I did that sundry account capital first, and now I've done the bank account, and I'm working from left to right through this journal. And the next account is Output VAT. Now, Output VAT is a liability. It is the money we collect on behalf of our revenue services. We owe it to the revenue services. It's a liability. And the liability has increased. We need to take the total of Output VAT to the Output VAT account. An increase in liability, the rule says the account must be credited. So we credit B11, which is the Output VAT account. And in the general ledger, there's VAT Boy, just a picture of VAT Boy checking up on his Output VAT. So an increase in liabilities, the account gets credited. Where did we get this information from? The Cashbook receipts number 2. What is a contra account in this case here of Output VAT? Bank. It had its own column, so the amount was posted on the last day of the month, 29th, and there's the date. 2024, February the 29th. The contra account to this Output VAT is bank, and the amount is 627391. So that amount there has been posted to the general ledger account, Output VAT. It was credited. Why? Because there was an increase in liabilities, and the rule says when there's an increase in liabilities, the account must be credited. And you are growing quickly, and you're staying in your lane. Oh no, a little bit of distraction, but you regain focus, and you're going like a Boeing. Keep it up, guys, keep it up. I'm now able to go a little bit faster. We're working our way from left to right. We've done bank, Output VAT. We posted to the capital account earlier. There's a column here for services rendered, but unfortunately no transactions took place during the month of February, so there's no posting to the services rendered or current income account. Then we move on to Debtors Control, and we know the school paid us a couple of sums of money on the 14th and the 21st, and we now need to do the Debtors Control accounts receivable. Remember, Debtors Control or accounts receivable is an asset, but in this case here we've received money, so the amount that the debtors owe us is less. We know when the value of an asset decreases, the account must be credited. So we're going to credit the Debtors Control account in the general ledger when we post this total to the ledger account, because the value of what our debtors owe us has decreased when they pay us. So a decrease in assets will go on the credit side of the general ledger account, because that's what the rules say we must do. So on the credit side of Debtors Control, which is an asset, we have a decrease in what the debtors owe us, decrease in the value of debtors, and therefore it goes on the credit side, and we take the total of the column to the credit side of the debtors control account. Contra account is bank. When did this transaction take place? Actually, when do we post? On the last day of the month, because debtors control has its own column. Where did the information come from? The Cashbook receipts, the cash receipts journal. So debtors control gets credited. So I've gone through that quite quickly, but I think you're getting the hang of taking information from a journal to the general ledger account. And we're on a path to success. We're going to flower, and we're nearly there. Hang in, keep going. And we get to the sales column. Sales has its own column, because hopefully you're making lots of sales in a month. So the sales total needs to be taken to the sales account in the general ledger, posted to the general ledger account. Sales is income, and we make a sale. When we make a sale, income increases, and the rule says if income increases, we need to credit the general ledger account. We need to credit the sales account. So we write in there credit N2, and N2 is the second nominal account in the general ledger. That is the folio for sales, N2. Remember, I will show you a trial balance, and I'll show you where the folios come from for each account. So in the general ledger, we have the sales account, left hand side the debit side, the right hand side the credit side, and the rule says an increase in income, we need to credit this account. Date, last day of the month, we take the total from the sales column to the general ledger, and we credit the general ledger account with the amount that was made from sales for the month of February. Where did we get this information from? The Cashbook Receipts Journal number 2, or the Cash Receipts Journal. So there we go. We went and credited sales in the general ledger. We applied our rules, our accounting rules, so we can't make a mistake. If we know the rules, we're well on our way to balancing our books at the end of the day. So keep up this good work. So we've done sales. Now let's see what our next account is. And I see in sundry here, we haven't posted to the interest on current account. We had a positive bank balance, and we picked up from the bank statement that we earned 173 on our current account, interest on current account. Interest earned is income, and if there's an increase in income, like sales, the account must be credited. So N4, the nominal account number 4, which is interest on current account, needs to be credited. Now this interest on current account appears under sundry, so it needs to be posted to the general ledger on the day the transaction took place. But we got this bank statement at the end of the month. So, well, stay with us. Don't fall asleep. I know it's tough, but keep going. The date 2024. Okay, we got the bank statement on the 28th. The contra account is bank. which journal did we get this information from, the Cashbook receipts, and the amount was 173. And we credited, we put the entry on the credit side because we applied the rule, an increase in income, there it is, the account must get credited. I always apply my rules. You need to always apply your rules. You can't learn accounting. If I debit this account, I must credit that account. You need to apply your rules, then debit or credit an account according to the rules. Watch that video of mine on the rules. It's a good one, comprehensive. And you are going to blossom and flower like a cosmos. We nearly finished the general ledger, posting from the Cashbook receipts to the general ledger. Hang in there. Now I've left the last column, the best column, for last. We still need to do this column, the cost of sales. Now, in my humble opinion, this column here should have been called cost of sales stroke trading inventory. Cost of sales and trading inventory, because this total here is going to be posted to two accounts, the cost of sales account and the trading inventory account. At the point of sale, cost of sales or trading inventory, you are getting rid of trading inventory, you are selling it. Now trading inventory is an asset, but at the point of sale we go and expense trading inventory and we open up an account called cost of sales because there was a cost of a sale. Now the reason why we open up this cost of sales account, it enables us to calculate a gross profit straight away when we're using the perpetual inventory system. From the total of this column as well, we can also keep a running balance of what should be on our shelves of trading inventory. I'm going to show you when I post this amount to these two accounts exactly what I mean. It will make a lot more sense. But this amount here in the cost of sales column goes to two accounts. Let's have a look. We're going to do the cost of sales account first. Remember I said cost of sales is an expense, and at the point of sale our expense, cost of sales, increases. An increase in expense, the rule says the account must be debited. So in green at the bottom here, I've said debit cost of sales, which happens to be N3 in the general ledger. And here we have the cost of sales account. So cost of sales, because it's an increase in expense, gets debited on the debit side on the last day of the month. Now the contra account to cost of sales is trading inventory. Very important. That's why I said cost of sales, this column here, you could have called it cost of sales trading inventory, because the total is taken to two accounts, the total of the column. So cost of sales is debited, and under details you will have the name of the contra account, trading inventory. Now that is the one entry. Now, what happens to trading inventory when you get rid of trading inventory? Trading inventory is an asset. When the stock leaves the building, the value of our stock on hand decreases. So it's a decrease in assets. So what happens to the trading inventory account? Let me clear that up. Remember, trading inventory is an asset. We credit trading inventory because the stock has left the building. It was sold. And a decrease in asset, the account must get credited. So here we have the trading inventory account. It's a B account, balance sheet account. It's an asset. The value of our stock decreased by the total of the cost of sales column. There's the total of the cost of sales column. Trading inventory got credited. The contra account is cost of sales. You see, cost of sales was debited and trading inventory gets credited. And the date, the last day of the month. So do you see the link between cost of sales and trading inventory? At the point of sale, we say trading inventory is expensed. Because what was the actual cost of the sale? It was the historical cost price of the stock that we are selling. There was a cost to a sale. It was the cost of the purchase price of the stock that we are selling. Now in this account here, trading inventory, we are showing that our stock on hand is less. It has decreased by 29,968. I haven't got the balances here on the debit side, but obviously we would have stock on hand most of the time when we sell stock. So trading inventory got credited, decrease in assets. Now remember, I'm only showing you the postings from the Cashbook receipts in this video. But there are also postings that go into trading inventory from the Cashbook payments when you bought stock, etc. But let's sum that up. The total from the cost of sales column gets posted to the cost of sales account and the trading inventory account. There we go. Cost of sales was an increase in expense and trading inventory was a decrease in the value of the asset. So it got credited. And this is you. You're starting to flower and blossom. Shortly I'm going to show you the actual general ledger, the Cashbook receipts, and the general ledger and the postings that you have made without all the scribbling. As we come to the end of this section on the Cashbook receipts, what I've got, I'm just going to take stock. I'm going to summarize what we've done. In front of you, you have the completed Cashbook receipts. All those transactions that resulted in an increase in our bank balance were recorded in this journal, the Cashbook receipts, or like I've said, you might know it as the cash receipts journal. So this is how you draw up the cash receipts journal. And then what we did was, okay, all this journal is drawn up from documents. There's the document column. I've showed you the documents and we've drawn up the journal. Then the next step was to post to the general ledger. So the information summarized in this journal, the totals were taken to the general ledger. We debited and credited the accounts appropriately according to the rules. We posted those items under sundry to the general ledger. In this example, it was the capital account and interest on the current account. We took the information from cost of sales and we debited cost of sales and we credited trading inventory. So you've come a long way in the last hour or so. And what you might need to do is watch this video regularly to master the Cashbook receipts. But I think you guys are smart, or you are smart, and you will catch on very quickly. Remember, this is supplementary to what you're doing wherever you're studying. It's just a lesson on the Cashbook receipts, the cash receipts journal, and posting to the general ledger from the Cashbook receipts. So in front of you, you have the completed Cashbook receipts without any prompts or markings. There, if you want to pause the video, you can have a good look at it. But that's what the Cashbook receipts looks like. In fact, you most probably wouldn't have these green markings if you're doing the Cashbook receipts. I've put that in there for learning purposes. And you, this is you. You've become a beautiful flower. What beautiful creations. So your accounting knowledge has increased, and on the next few slides I'm going to show you what the general ledger looks like once again after taking the information from the Cashbook receipts to the general ledger. Now we've posted all the transactions from the Cashbook receipts to the general ledger. I'm going to show you the general ledger accounts that were affected by the transactions in the Cashbook receipts. There was a capital contribution. There was a sale of trading inventory. Debtors paid us. Increase in capital. The rule says the account must be on the credit side. Trading inventory. The value of our trading inventory decreased. A decrease in assets. The rule says the account must be credited. Debtors control. Debtors paid us. The value owed by the debtors decreased. A decrease in assets. The account must be credited. Do you see? I'm emphasizing the rules. The rules are extremely important. This is the general ledger of our business, Caleboo Education. So this information has been taken from the journal for February, the Cashbook receipts, to the general ledger. And as we go further into the general ledger, we get to the bank account. Remember, these green references here are the folio references for these accounts. Balance sheet account number 9 for bank. Output VAT balance sheet account number 11. So bank with a positive bank balance is an asset. Increase in assets because of the receipts we earned, or the money we received in the month of February, and we post the total amount. Output VAT liability. We owe this money to revenue services. There's an increase in liabilities, and the rule says the account must be credited. There's VAT boy. He likes the limelight. He pops up all over the show when there's VAT involved. So this is the general ledger, and let's move on to possibly the nominal accounts, our income and expense accounts. So let's move on. Looking at the nominal accounts section, which means we're looking at the income and expense accounts. We had sales for the month of February. Remember, we've only recorded February, and I'm showing you the postings from the Cashbook receipts for February to the general ledger. Sales, it was an increase in income, so the account was credited. Cost of sales was debited because an increase in expense, cost of sales is an expense, the account must get debited. And remember, cost of sales is linked to trading inventory. At the point of sale, we bring cost of sales into account by expensing trading inventory, and this enables us to calculate our gross profit. And gross profit, by the way, is sales minus cost of sales. I don't have the trading inventory account in front of me at the moment, but trading inventory would have been credited with this cost of sales amount, and we will be able to keep a balance of stock in our books, which should be the same as if you go and do a stock take as what's on the shelves, but more about that later. So we've taken the information from the Cashbook receipts to the general ledger, to the sales account, and to the cost of sales account. Then there was also interest that was earned on a current account, and interest is income. An increase in income, the rule says the account must be credited. So now I've shown you the general ledger with all the transactions from the Cashbook receipts only. As we go through this series, I'm going to include the transactions from the Cashbook payments, the debtors journal, the creditors journal, the allowance journals, the petty cash journal, the general journal, and you're going to become masters of bookkeeping. And now that you've blossomed and you're doing extremely well, be careful of another beautiful creation, but sometimes looks can be deceiving. Be careful now that you're doing well, you don't get eaten up. In summary, let me just show you and recap what we've just done in the last couple of hours. Transactions took place for the month of February. These transactions were recorded on source documents. We completed the Cashbook receipts, and from the Cashbook receipts we posted this information from the Cashbook receipts to the general ledger. So it looked like this. These were the transactions: a capital contribution, cash sales, debtors paid us, accounts receivable, interest was earned on a positive bank balance. Those transactions were documented on receipts. These are the documents which record transactions that go into the Cashbook receipts. There's a cash invoice, a cash slip, cash register roll. We used deposit slips to bank the money on various days. We received a bank statement and we recorded transactions that were on the bank statement but not yet in our books. These source documents we used to record information in the Cashbook Receipts Journal. And from the Cashbook Receipts Journal, we posted the information to the General Ledger. So you've come a long way. We've done the Cashbook Receipts, and we posted the information to the accounts in the General Ledger. Just a little background to this video. There's the flower bed where the cosmos for this video, that's where the cosmos was grown. This little flower bed came about during COVID when travel was restricted. So I made this flower bed and planted some cosmos, and we did online classes from the backyard, but the cosmos was grown right there for this video. And there we go. That's what was produced in this little flower bed. Beautiful flowers, just like you. And this caterpillar, the picture was actually taken on a trail which my wife was doing. I hope you enjoyed this video. That's the end. It's lovely to see you people growing. Take care. I hope you enjoyed my video, and thanks for watching. And once again, thanks for purchasing this video. I really value it.